Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the true titans of industry, a company that's been, foundational to the global economy for over a century, Chevron Corporation, tickers CVX. On the surface, it's this massive, established energy giant. But the real question for us as long-term investors, for you, the learner, is this. Is Chevron an enduring, wonderful company, the kind you can confidently build a core multi-decade holding around? Or is it more of a capital-heavy commodity business facing, terminal decline in this energy transition era? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use interactive brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know, and frankly to get the next one, is to subscribe and like the video. It genuinely helps the channel grow. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model.
Okay, let's unpack this. Chevron operates what's known as a vertically integrated business model. We hear that term a lot, but for someone perhaps newer to the specifics of the energy sector, what does that actually mean in practice for a company like Chevron? And maybe more importantly, why is this structure such a key strategic element for, resilience in such a volatile industry?
Yeah, that's exactly the right place to start, because this vertical integration, it's really foundational to Chevron's strength, its endurance. Essentially, Chevron's operations cover the entire life cycle of oil and gas. I mean, from literally finding it deep underground to, selling the finished product at the pump. The easiest way to think about it is through its two main segments, upstream and downstream.
Okay. Upstream and downstream.
Right. So the upstream segment, that's all about the exploration, the development, and then the production. Think of it as the geological hunt, finding the oil and natural gas, and then the whole process of actually extracting it from their global reserves, which are vast. Its revenue, that comes pretty much directly from selling these raw commodities, crude oil, natural gas on the global market. Often they have long-term contracts in place. So you can see the profitability of upstream is powerfully directly tied to global commodity prices. What price can they actually realize per barrel of oil or per 1,000 cubic feet of natural gas? When those prices are high, upstream is extremely profitable.
Got it. So upstream is find it, get it out, sell it raw. Mm-hmm. What about downstream then?
Downstream is where the transformation happens. This segment handles refining, marketing, and also chemicals operations. It takes that crude oil, sometimes it's Chevron's own from upstream, sometimes they buy it on the open market, and processes it through this huge global network of refineries. The output is, it's a massive range of finished products, gasoline, obviously, diesel, jet fuel, lubricants, and various petrochemicals too.
Petrochemicals like plastics and things.
Exactly. The building blocks for plastics, solvents, all sorts of materials. And these finished products, they're then marketed and sold to a really diverse customer base. I mean, everyone from you and me at the local Chevron or Texaco station to huge commercial clients like airlines buying jet fuel or industrial manufacturers needing lubricants or chemical feedstocks. Now, the profitability driver here is different. It's driven by refining margins. You often hear the term crack spreads.
Crack spreads, right.
Yeah, it's simply the difference between the cost of the crude oil they put in and the selling price of those refined products they get out.
Okay, this is where it gets really interesting, I think. This integrated structure, upstream and downstream, you mentioned it creates resilience. How does it form what's sometimes called a natural hedge against that price volatility?
Yeah.
Can you walk us through how that actually cushions the company's overall earnings?
Yeah.
Because energy prices, they can swing wildly.
Absolutely. And this natural hedge is precisely why the integrated model is so valuable for long-term stability in, let's face it, a very cyclical industry. So imagine a scenario where crude oil prices are low.
Okay, oil's cheap.
Right. This obviously compresses the profitability of the upstream segment, doesn't it? They're selling their raw material for less money. But think about the downstream segment. For them, crude oil is their main input cost.
So the raw material cost goes down.
Exactly. So when crude prices are low, downstream's input costs decrease, which typically leads to expanded refining margins. Those crack spreads get wider. This extra profit in downstream then helps cushion the company's overall earnings, kind of making up for some of that weakness in the upstream.
Okay, I see that side. What about when oil prices shoot up?
Right, let's flip it. When crude oil prices are high, the upstream segment generates immense profits, right? They're selling their oil and gas for a lot more. Now, high crude prices might potentially squeeze the margins in the downstream business.
Because their input costs just jumped.
Correct. Their input costs have gone up. But the huge profits coming from the upstream side more than compensate for that potential squeeze. So in essence, Chevron's integrated model acts like a built-in shock absorber. It smooths out that roller coaster of commodity prices. You know, pure play companies, ones that only do exploration and production or only do refining, they often get whipsawed by these price swings.
Right, they feel the full force.
Exactly. Chevron's model provides a level of through-cycle earnings stability that those pure plays just don't have. And that is a fundamental strength for long-term stability. It's really a crucial characteristic if you're looking for a business, that you intend to hold for decades.
That business model, with the natural hedge, it certainly sounds robust today. Let's zoom out again. The prevailing narrative, you hear it everywhere, is about this impending energy transition away from fossil fuels. Given that, how does a company fundamentally built on oil and gas truly stay relevant for, say, the next 10, 20 years? With all the talk of renewables, EVs, is that stability you just described maybe just a temporary illusion facing a massive shift?
That is the core question, isn't it? And look, the energy transition is absolutely real. It's ongoing. But despite that, this integrated model's endurance, I believe, is anchored in two really powerful structural realities that I think are often underestimated by the market. First, there's just the immense inertia of the global energy system itself. I mean, just think about it. The vast majority of the world's industrial infrastructure, transportation, even residential heating and cooling, it's overwhelmingly reliant on hydrocarbons right now.
Cars, trucks, planes, factories.
Everything. We're talking about the materials used in manufacturing, heating homes, transitioning this entire global system. It's not like flipping a switch. It's a multi-decade, probably multi-trillion-dollar endeavor. Even major energy outlooks, from organizations deeply involved in the transition like the International Energy Agency or consulting firms like McKinsey, they project that global oil demand, while it might peak sometime around 2030, give or take, it's still expected to remain near or even above 100 million barrels per day out to 2040.
Wow, 100 million barrels a day in 2040. That's similar to now.
Pretty close to today's consumption, yeah. And that's largely because the global vehicle fleet, all the cars and trucks out there, it just turns over very slowly. People don't buy new cars every year. And industrial assets, factories, power plants, they have incredibly long lifespans, decades sometimes. Their energy needs don't just change overnight.
Okay, so the existing infrastructure creates a kind of long tail for demand. What's the second reality?
The second point, and this is really crucial, is that a significant and actually growing portion of oil demand isn't even for burning as fuel in engines, it's for non-combustion uses, primarily as essential feedstock for the petrochemical industry.
Back to the plastics and materials.
Exactly. We're talking about products like naphtha, liquefied petroleum gas, LPG. These are fundamental building blocks for creating plastics, solvents, polymers, materials that are absolutely essential to modern life. Think medical devices, packaging, clothing, electronics. And the demand for these materials is driven by powerful long-term secular trends: global population growth, rising living standards, particularly in developing economies. People want more stuff, better healthcare, more advanced materials. And this type of demand is largely insulated, you could say, from the shift toward electric vehicles or renewable power generation. EVs don't change the need for plastics.
That's a really important distinction.
It is. So if you connect this back to the bigger picture, it strongly suggests that while the energy landscape is definitely shifting, the fundamental underpinnings of demand for Chevron's core products, both fuel and non-fuel, seem remarkably durable for the foreseeable future. This makes their business model highly relevant, I'd argue, for years, even decades to come.
That durability brings us nicely to competitive advantage. Every truly wonderful company, as we know, has some kind of competitive fortress, an economic moat protecting its returns. What are Chevron's primary economic moats? How do they actually defend their position in what's, let's face it, a fiercely competitive global market?
Chevron's primary moat is, well, it's quite formidable. It really stems from a powerful combination of two things: cost advantages and efficient scale. The cost advantages come directly from their portfolio of genuinely world-class upstream assets. These are oil and gas fields that are low cost to develop and operate and have very long production lives. Basically, they can get oil and gas out of the ground for significantly less money than many of their competitors. That gives them a structural profitability edge, especially when prices are low.
Lower cost structure, right, and efficient scale.
Efficient scale is about the sheer size and complexity needed to play at Chevron's level. Think about the enormous capital investment required just to build these massive offshore platforms or sprawling refinery complexes. Then add the advanced technological expertise needed, the complex logistics, the need to navigate intricate regulations across dozens of countries. All of this naturally limits the number of potential new entrants. It effectively creates a market structure where only a handful of very large integrated players like Chevron can really operate efficiently and compete globally. Now, they do have other assets, like their strong brand names, Chevron and Texaco, are well-known and proprietary technologies, like Techron. These are valuable, no doubt, but I'd argue they are secondary to those core structural advantages, low-cost assets, and the scale required to operate them.
Okay, let's try and make that cost advantage more tangible. The Permian Basin, out in West Texas and New Mexico, it's often highlighted as a sort of microcosm of this advantage. How does Chevron's operation there really demonstrate concretely the superior cost structure and operational excellence, beyond just the theory?
Yeah, the Permian is a fantastic real-world example of how Chevron's moat actually works in practice. And the key takeaway isn't just that they're low cost there, it's how they achieve it. It's very deliberate. So let's look at the numbers first, just to frame it. Chevron's Permian operations, they boast break-even costs, the oil price they need just to cover expenses, somewhere in the range of $30 to $40 per barrel.
$30 to $40. And the average is...
The industry average in the Permian is typically quite a bit higher, maybe $45 to $55 per barrel, so that's a significant cushion right there. And if you look at their actual production costs, just the cost to lift the oil out once the wells are drilled, Chevron averages a very lean $10.50 per barrel. The Permian average is closer to $15.20.
Wow, that's almost a third lower. That adds up across millions of barrels.
It adds up massively to the bottom line, yes. But crucially, this isn't just because they got lucky with the geology, though they do have great acreage. It's engineered. They employ really sophisticated operational strategies. For instance, they use something called a cube development methodology. Instead of drilling wells spread out, they cluster them very densely in a sort of cube shape underground. This lets them optimize all the surface infrastructure, roads, pipelines, power, and it drastically reduces the capital intensity per well. Think of it like building an apartment complex instead of single-family homes. You share foundations, utilities, etc.
More efficient use of capital.
Much more. They're also leaders in multi-well pad drilling. They'll drill maybe 12, sometimes even 16 wells from a single surface location or pad. The industry average might be more like 8 to 10 wells per pad. Again, sharing infrastructure, fewer truck trips, less surface disturbance. It adds up. They estimate this saves them roughly $200,000 per well compared to smaller pads.
Okay, these sound like smart engineering efficiencies. Anything else?
Oh yeah, they're constantly innovating. They recently implemented this technique they call triple frac. Hydraulic fracturing, or fracking, is how they stimulate the rock to release the oil. Historically, you'd do one well at a time. Then came simul-frac, doing 2 simultaneously. Chevron's now doing 3 wells at once from the same pad.
3 at once. How does that help?
It dramatically cuts down the completion time, the time it takes to get the well ready to produce, by about 25%. And it reduces the cost per well by another 12% compared to even the simul-frac method. Plus, they're heavily leveraging advanced data analytics using sensors and algorithms to predict subsurface bottlenecks before they happen. This alone has reduced their drilling downtime by something like 23%.
So it's a combination of planning, technology, and continuous improvement.
Exactly. These aren't just minor tweaks. These are deeply embedded structural advantages built into their entire Permian operating system.
And how does this low-cost position let them, as you said, repel competition or exercise market power? Can you give an example?
Yeah, a great example is the period between 2020 and 2022, when the oil market was incredibly volatile, remember. Prices crashed, then recovered. During that time, Chevron really demonstrated its strength. They made the tough decision to cut their capital spending in the Permian by a huge 50%.
Cut spending by half. Did production plummet?
That's the amazing part, no. They managed to maintain their production output relatively flat, even with that massive spending cut. Now, compare that to many of their competitors in the Permian during the same period. A lot of them were actually generating negative free cash flow, burning cash, while trying to grow production to capture higher prices later. Chevron's ability to remain highly profitable even at lower oil prices basically forces those higher cost producers to pull back, to curtail their own drilling activity when prices dip. In effect, the high-cost players are forced to cede market share to Chevron during downturns, and this allows Chevron to consistently generate superior returns on the capital they employ their ROCE. We've seen them achieve 12% ROCE in the Permian, while the peer average is often stuck down around 6% to 9%.
That's a clear illustration of the moat in action. It allows them to be profitable when others aren't and forces weaker players out.
Precisely. It's a powerful competitive advantage.
That level of engineered excellence in the Permian, it really does set them apart. It makes you wonder, though, if they're this strong now, what does that tell us about the future trajectory of this competitive advantage? Is this moat kind of static, just holding its ground? Or is there evidence it's actually getting wider over time?
That's the crucial question for any long-term investor, isn't it? And based on the evidence, the trajectory of Chevron's moat appears to be stable to widening.
Stable to widening. Okay, why stable?
Its stability is really anchored by Chevron's incredibly disciplined development approach. They aren't just drilling randomly across their vast Permian acreage. They're laser-focused on what they call their core of the core locations, the very best rock. This disciplined focus gives them, they estimate, about a 15-year inventory of top-tier drilling sites that remain highly profitable, even if oil prices were to drop back down to, say, $50 a barrel. That provides real longevity to their low-cost advantage.
15 years of runway at $50 oil. That's significant stability. How is it widening, though?
It's actively widening through a couple of key mechanisms. First, we've seen really astute strategic acquisitions. Think about Noble Energy back in 2020, PDC Energy in 2023, and now the really impactful Hess Corporation acquisition expected to close soon in 2025. These deals weren't just about getting bigger. They systematically added high-quality, low-cost reserves, primarily bolstering their positions in the Permian and the DJ Basin, but also adding key international assets. These acquisitions deepen their inventory of advantaged, low-cost drilling opportunities.
So smart M&A is adding more low-cost resources.
Yes. And simultaneously, they're bringing massive organic projects online. The prime example is the successful startup of the huge Tengiz Future Growth Project, they call it FGP, in Kazakhstan. This is a super giant oil field, one of the biggest in the world, with exceptionally low production costs. FGP is set to add something like 260,000 barrels per day of very high margin production. This further cements Chevron's position on the low end of the global cost curve, and it will contribute for decades.
Okay, so acquisitions plus major low-cost projects.
Right. Now, stepping back, while the long-term energy transition definitely poses a risk to the overall demand for hydrocarbons, it doesn't necessarily threaten Chevron's relative cost advantage versus its peers. In fact, you could argue the opposite. Well, think about a future scenario with potentially flat or even declining overall oil demand. In that world, who survives and thrives? It's the producers with the lowest costs. They will be the last ones standing, the most profitable survivors. They'll likely even gain market share as higher cost competitors are forced to shut down or consolidate. So this raises an interesting point. When we talk about a widening moat in what many consider a mature, maybe even sunset industry, what does that really imply? It suggests an ability not just to survive, but to actually thrive against the competition. Even if the overall pie isn't growing anymore, they can take a bigger slice of a stable or shrinking pie.
That's a critical distinction. It's about relative strength. Okay, moving beyond the hard assets and financials, a company's long-term success is also heavily influenced by, well, its relationships with key stakeholders, namely customers and employees. What does the scuttlebutt, that informal chatter and feedback, tell us about Chevron from these perspectives? Maybe starting with the customer. Can you give us a feel for what a typical Chevron customer might experience or perceive?
Yeah, the scuttlebutt definitely offers valuable qualitative insights. From the customer's perspective, let's be realistic, people don't usually love their gasoline company the way they might love, say, Apple or Starbucks.
Right, it's more of a necessity.
It's a necessity, exactly.
Yeah.
However, Chevron seems to have cultivated a relationship that ranges from maybe tolerance to genuine appreciation, and that's driven primarily by the perceived quality of its products. The key differentiator here, as we touched on briefly, is their proprietary Techron additive. It's blended into all their grades of gasoline.
Techron. You see the ads for it. Does it actually resonate with consumers?
It appears so. If you look at online forums where people discuss gasoline quality, car enthusiast sites, consumer reports forums, things like that, Chevron consistently gets placed in the top tier category. That's a standard indicating a certain level of detergent additives. But beyond that, you see consumers frequently reporting tangible benefits they believe they get from using Chevron with Techron. Things like smoother engine operation, maybe slightly better acceleration, and often claims of better fuel economy. For instance, it's not uncommon to find an anecdotal report in a forum where someone says, hey, I switched to Chevron consistently and I'm getting over a 10% better mileage per tank compared to the cheap generic stuff. They almost always attribute that directly to Techron's cleaning properties, keeping the engine running efficiently.
Interesting. So anecdotal but consistent feedback.
Exactly. And maybe even more telling, the standalone Techron additive, the bottle you can buy at Walmart or an auto parts store to pour into your tank, it receives overwhelmingly positive reviews online. I saw one site, I think it was Walmart's, where it had something like 87% 5-star reviews out of hundreds of reviews.
That's pretty strong validation from people actively buying the additive itself.
It is. So this strong brand association with a premium, perhaps engine-protecting product allows Chevron to command a degree of pricing power at the pump. They're often not the cheapest gas station, but they foster a loyal customer base that's willing to pay a few cents more per gallon because they perceive a quality difference thanks to Techron.
Okay, that makes sense for the customer side. What about the employee perspective? What's the general feeling inside the company based on reviews and feedback? Is it a good place to build a long-term career?
From the employee perspective, the overall picture seems to be a net positive for long-term success. The culture is generally characterized by stability, a very, very strong focus on safety, which is paramount in this industry, and good opportunities for internal advancement. Of course, you always have the complexities that come with being a massive global organization. If you look at employee reviews, say on sites like Glassdoor, you consistently see praise for competitive compensation and benefits packages. They also frequently mention a strong emphasis on trying to maintain work-life balance, which isn't always easy in demanding operational roles. And that unwavering commitment to safety culture comes up again and again. I even saw a quote from a former employee who'd been there 31 years, just describing it simply as a great company to work for. They also seem to have pretty good internal hiring and development processes, suggesting a culture that does invest in its people for the long haul rather than just churning through them.
Stability, safety, development. Sounds positive. Are there common downsides mentioned? Every big company has its issues.
Oh, absolutely. And the primary criticisms you hear relate directly to that immense size and complexity. Words like bureaucratic, siloed between different departments or regions, and having a steep learning curve for new employees pop up frequently. Some employees also mention a bit of a disconnect sometimes between the high-level corporate mantras you might hear from headquarters and the day-to-day reality on the ground. You might see comments about instances of micromanagement from certain layers or concerns, especially during downturns about layoffs or outsourcing of certain functions. So it's not perfect, naturally.
So we have these valid criticisms, particularly around the bureaucracy, maybe feeling like a small cog in a very large machine. But do these issues seem to rise to a level that fundamentally threatens the company's core mission? Especially that mission of operational excellence, given the intense focus on safety and the long-term development you mentioned. Do the negatives outweigh the positives in terms of getting the job done reliably?
That's the key question, isn't it? And based on the overall pattern, while that bureaucratic friction is certainly a valid concern and undoubtedly a source of frustration for some employees, it doesn't appear to rise to a level that truly threatens the company's core mission of operational excellence. In fact, you could almost argue the flip side. That cultural emphasis on safety, on stability, on long-term employee development and retaining expertise, these are actually significant assets for a capital-intensive business like Chevron. They rely so heavily on executing incredibly complex, decades-long projects safely and efficiently. Having that stable, experienced workforce with a deeply ingrained safety culture is critical.
So the bureaucracy might be inefficient in some ways, but the stability and safety culture are paramount for what they do.
Exactly. It seems to ensure consistency and expertise in these high-stakes operations where errors can be catastrophic financially and environmentally. So no, I'd say the positives in terms of culture likely far outweigh the negatives when you consider the impact on long-term operational success and risk management.
Okay, that's a helpful perspective. So we've established Chevron seems to operate a pretty durable business with a formidable, maybe even widening moat.
Yeah.
Let's pivot now to the quality of its leadership. How do we really judge the quality of a management team? And how does Chevron's leadership stack up, particularly when it comes to capital allocation? That seems absolutely crucial for a long-term investment case.
Judging management quality, you're right. It ultimately boils down to understanding their operating philosophy and maybe most importantly, looking at their long-term track record of how they allocate the company's the shareholders' capital, really.
Mhm.
In Chevron's case, the current CEO is Michael Wirth. He's been chairman and CEO since 2018, but he's what you'd call a Chevron lifer. He joined the company way back in 1982, straight out of college, I believe.
Wow. Over 40 years with the company.
Yeah, that kind of career-long tenure gives him an almost unparalleled, deep understanding of Chevron's vast global assets, its complex operations, its different business units, and importantly, its deep-seated corporate culture. He's seen multiple cycles. If you read his public communications, his annual letters to stockholders are very insightful. And even, interestingly, his 2022 letter to the U.S. president, during that period of really high energy prices, you see a core philosophy emerge. It's very pragmatic, highly disciplined, and intensely focused on delivering value to shareholders.
What are the key priorities he emphasizes?
He consistently articulates 4 very clear financial priorities. And frankly, these have guided Chevron for decades, not just under him. Priority 1, consistently grow the dividend. 2, invest capital efficiently in high-return projects. 3, maintain a strong, fortress-like balance sheet. And 4, repurchase shares opportunistically through the cycle. This isn't the language, of an empire builder just focused on getting bigger for the sake of getting bigger. It's the language of a rational capital steward, focused on returns for the owners. His measured, often quite direct responses to various political and social pressures also underscore this commitment. He seems focused on maximizing long-run value for the company's owners, rather than just, bending to every external win or chasing short-term headlines.
Okay, that's the philosophy. How does the track record back that up? Let's look at the evidence of that capital allocation. Maybe start with reinvesting in the core business. Capex.
Right. Let's look at the track record across the key areas. First, reinvestment in the core business. Capex, capital expenditures. Here, management has shown, I think, exemplary capital discipline. That's a really critical trait in a highly cyclical industry where it's easy to overspend at the top of the cycle. We already mentioned how, in response to the severe market downturn in 2020, they acted swiftly and cut capital spending by a dramatic 35%. That takes discipline. More recently, their capital budget's around $16 billion planned for 2024, maybe $15 billion for 2025. They remain very disciplined. And importantly, they're strategically focused on their highest return assets, primarily funding projects in the Permian Basin and the deepwater Gulf of Mexico. It's also worth noting this spending includes a pragmatic allocation, roughly $2 billion per year currently, towards lower carbon initiatives, things like carbon capture, hydrogen, renewable fuels. This reflects, I think, a balanced approach. Sustaining the profitable core business while also prudently investing, exploring options in future energy systems without betting the farm.
Disciplined CapEx, focused on high returns, balanced approach. Okay, what about acquisitions? M&A activity.
Second, acquisitions. M&A. Chevron's recent M&A activity has been, I'd say, consistently strategically logical and importantly value accretive. They haven't chased those dilutive, headline-grabbing mega deals that sometimes destroy value. Instead, their focus seems squarely on acquiring high-quality, low-cost assets that genuinely strengthen their existing portfolio and fit strategically. We talked about the Noble Energy deal in 2020 and PDC Energy in 2023. Both significantly bolstered their positions in the key U.S. shale basins, Permian and DJ, and also added valuable low-cost natural gas reserves in the Eastern Mediterranean. And then, of course, there's the most notable one, the recent $53 billion all-stock acquisition of Hess Corporation. This looks truly transformative and strategically very sound. It gives Chevron that crucial 30% ownership stake in the Stabrook block offshore Guyana, again, arguably the world's most significant oil discovery in the last decade. It's a world-class, high-growth, very low-cost asset. This deal is expected to be immediately accretive to cash flow per share and should extend Chevron's growth profile well into the next decade, maybe even longer. And importantly, doing it as an all-stock deal preserves their balance sheet strength.
Smart strategic M&A focused on quality and fit. What about the third piece, returning cash to shareholders?
And third, yes, shareholder returns. Management's commitment here is, frankly, exceptional. Just look at 2023. The company returned a record $26.3 billion to its owners. That was made up of $11.3 billion in dividends and a huge $14.9 billion in share repurchases. As of mid-2025, Chevron has returned over $5 billion to shareholders for an astonishing 13 consecutive quarters. Rain or shine, that cash is flowing back. And perhaps the most impressive statistic, the clearest hallmark of their shareholder focus. The company has increased its annual dividend per share for 36 consecutive years. Through multiple oil price crashes, recessions, the pandemic, That dividend has kept climbing. That takes incredible discipline and a genuine view of shareholders as true partners in the business.
36 straight years of dividend increases. That's dividend aristocrat territory, isn't it?
Absolutely. It's a very elite club, especially for a company in such a cyclical industry.
So taking that whole track record together, the disciplined spending, the strategic M&A, the massive shareholder returns, what does it tell us about the rationality of this management team? Does it truly seem aligned with long-term owner interests? Or could there be hidden motivations we should worry about, like just building a bigger empire?
Based on this multi-decade evidence, the conclusion seems overwhelmingly clear. This is a rational, highly disciplined, and profoundly shareholder-friendly management team. Their consistent focus on maintaining that fortress balance sheet, delivering a reliable and growing dividend through thick and thin, executing opportunistic M&A but only for high-quality assets that fit, and then engaging in large-scale share buybacks when cash flows are robust. That is the complete antithesis of value-destructive empire building. They prioritize the return to shareholders over simply growing the size of the company for its own sake. It really feels like an owner-operator mindset running through the entire capital allocation framework.
That's a very strong endorsement of the leadership's approach. Okay, so the financial statements, logically, should reflect this discipline and the underlying operational strength. How robust is Chevron's financial fortress, really? Especially considering, again, it operates in an industry known for sometimes extreme cyclicality and potential for wild swings in earnings.
Yes, Chevron's financials do indeed reflect both that operational strength we discussed and the disciplined management. Now, are its earnings perfectly smooth? Of course not. By their very nature, they're subject to the inherent cyclicality of commodity markets. But the key is that its financial structure provides a really powerful margin of safety, allowing it to navigate those swings much better than most. I'd describe its profitability profile as a cyclical but powerful machine. It absolutely can and did swing from posting a net loss during the depths of the 2020 pandemic shutdowns to achieving record profits in 2022 when prices surged. The key quality here, though, isn't just hitting those peaks. It's the company's demonstrated ability to generate substantial cash flow, even in weaker price environments. And that ability comes directly from having that low-cost asset base and the stabilizing effect of the integrated model we talked about earlier.
Can you put some numbers on that cash flow generation?
Sure. So in that banner year 2022, Chevron generated a record $49.6 billion in cash flow from operations CFFO. And after Capex, a staggering $37.6 billion in free cash flow FCF. That's cash available for dividends, buybacks, debt reduction, etc. Even in the more moderate price environment of 2023, it still produced a very robust $35.6 billion in CFFO and a really healthy $19.8 billion in FCF. What this demonstrates is just an immense and, importantly, reliable capacity to generate real, spendable cash for its owners. That's the lifeblood of any business, especially one committed to returning capital.
That FCF generation is impressive, even in a moderate year. Can we look at some key quality ratios to get a quantitative feel for the business health over time? Maybe over the last 5 years, which included that downturn in the upcycle?
Absolutely. Looking at ratios over a cycle gives a much better picture. Let's take 3 key ones. First, return on invested capital, ROIC. This tells us how efficiently they're using all the capital tied up in the business debt and equity to generate profits. As you'd expect, it was negative in 2020 during the pandemic loss. But then it rebounded strongly, approximately 9.4% in 2021, soared to 20.3% in that record year 2022, settled back to a very respectable 11.9% in 2023, and for the trailing 12 months ending Q2 2025, it's running around 10.1%.
It tells you that while cyclicality is absolutely present in normal to strong commodity price environments, Chevron consistently generates returns on its capital well in excess of its cost of capital, likely in the 10-15% range typically. That peak over 20% in 2022 is a powerful indicator of a high-quality business with a strong economic moat. It can earn exceptional returns when conditions are favorable.
Okay, ROIC looks strong through the cycle. What about free cash flow conversion? How much of that accounting profit turns into actual cash? Right? Free cash flow, FCF conversion, is a crucial metric. It tells us how much of the reported net income actually translates into real, spendable free cash flow. This wasn't applicable in 2020 due to the net loss, but look at the subsequent years. 135% conversion in 2021.
Wait, over 100%? How's that possible?
It can happen due to non-cash charges, like depreciation being high relative to capital expenditures in a given year, or favorable working capital movements, but the key is consistency. It was 106% in 2022, 93% in 2023, and running around 97% for the trailing 12 months as of Q2 2025. This metric is critical. It shows that the company consistently converts over 90% and often more than 100% of its reported net income into free cash flow. This is a vital sign of high-quality earnings. It demonstrates that the accounting profits you see are genuinely translating into real spendable cash for the owners, not just getting tied up in inventory or receivables or being offset by massive capital needs. It's real cash.
High-quality earnings converting to cash. Got it. Finally, what about the balance sheet? Leverage.
Finally, let's look at their leverage using the net debt to EBITDA ratio. This compares their debt, net of cash, to their earnings before interest, taxes, depreciation, and amortization, a measure of cash earnings power. It did peak during the extreme stress of 2020, but only at a very manageable level of approximately 1.8x. Since then, it came down rapidly, around 0.8x in 2021, an incredibly low 0.1x in 2022 when cash flow was booming, 0.3x in 2023, and currently sits around 0.5x for the trailing 12 months as of Q2 2025.
Wow, 0.5x net debt to EBITDA. That's incredibly low leverage.
It really is. This balance sheet truly is a fortress. The leverage ratio remains exceptionally low, typically well below 1.0x, even considering the Hess acquisition is largely stock-based. It only briefly went above 1.0x during the absolute worst of the pandemic stress. This provides Chevron with a massive margin of safety and enormous financial flexibility. It allows them to weather downturns comfortably, continue paying dividends, and act opportunistically with acquisitions like they did with Hess without jeopardizing their financial health. So, connecting this back to the bigger picture, it's very clear that the company's financial structure provides a powerful safety net, allowing it to navigate the inherent volatility of its industry while still generating significant, reliable value for its owners year after year.
Okay, we've built a strong case here. Chevron seems to have high business quality, a formidable widening moat, disciplined shareholder-friendly management, and of course its balance sheet. Now we arrive at the final, crucial analytical step, assessing the relationship between its current stock price and its intrinsic value. Because even the world's best company can be a poor investment if you pay too much for it. So what do the numbers tell us about Chevron's current valuation, say, as of August 2025?
Exactly. Price is what you pay, value is what you get. This is the critical step. As of roughly August 2025, let's look at the key valuation ratios. Chevron's price to earnings, or PE ratio, calculated using its earnings over the last 12 months, TTM, is sitting at approximately 17.2 times earnings. And its price to cash flow, PCF ratio, again on a trailing 12-month basis, is approximately 8.9 times cash flow.
Okay, 17.2x PE, 8.9x PCF. How do those compare historically for Chevron?
Good question. Context is key. The current PE of 17.2x is actually slightly above the company's 5-year average PE, which comes in around 16.0x, so a little higher than the recent past. However, it's significantly below its 10-year average PE, which is way up at 26.4x. But it's really important to add a major caveat there. That 10-year average was heavily skewed higher by several years, particularly around 2015, 2017, and 2020, when oil prices were depressed and Chevron's earnings were very low, which naturally inflates the PE ratio. So that 10-year number isn't necessarily a great benchmark for normal valuation. The 5-year average is probably more relevant.
Okay, so maybe slightly above the 5-year average PE, well below a skewed 10-year average. What's the crucial judgment then? Based on everything we've discussed, the quality, the moat, the management, is the current price fair, cheap, expensive?
The crucial judgment, synthesizing all of that deep analysis we've done on Chevron's business quality, its widening economic moat, and the proven disciplined stewardship of its management, is this. The current price seems to represent a fair, perhaps even bordering on attractive entry point for a patient long-term owner.
Fair, bordering on attractive. Why do you say that? What might the market be missing?
Well, the market, in our view, appears to be somewhat overly focused on two things right now. The inevitable short-term volatility of commodity prices, which we know is part of the game, and that perceived long-term, maybe existential risk posed by the energy transition. What it seems to be potentially undervaluing are two very significant factors. First, the substantial high-margin growth that is pretty clearly going to be delivered by those recently acquired assets in Guyana via the Hess deal. And second, the sheer durability and scale of the cash flows coming from its incredibly low-cost, high-efficiency operations in the Permian Basin. So the bottom line is this. For a business of this caliber, high quality, strong moat, great management, solid financials, which also offers a secure and growing dividend yield currently around 4.5% and has a clear multi-year pathway now to significant production and free cash flow growth. Well, the current valuation appears to be a very reasonable price to pay for a piece of this enduring franchise. It doesn't seem excessively cheap, but it certainly doesn't look expensive given the quality and outlook.
That makes sense. Okay, shifting gears slightly Any long-term investment thesis needs to clearly understand the future growth drivers, but also soberly assess the risks that could genuinely, permanently impair the company's earning power. So looking forward, what is the primary growth engine for Chevron now? And on the flip side, what are the most significant permanent risks that could truly threaten its long-term viability?
Looking ahead for Chevron's future earnings growth, the single most important identifiable driver is, without a doubt, that recently completed acquisition of Hess Corporation.
It really comes back to Guyana, doesn't it?
It really does. This transaction gives Chevron that 30% ownership stake in the Stabrook block offshore Guyana. And this isn't just another oil field. It's been consistently described as the world's largest oil discovery in the last decade, maybe longer. It holds reserves currently estimated at more than 11 billion barrels of recoverable oil equivalent, and they keep finding more. This is a genuinely world-class asset. It's high growth, expected to ramp up production significantly over the next 5 to 7 years. It's high margin because the operating costs are very low and the contract terms are favorable, and critically, it's very low cost development. It's expected to drive significant growth in both production volumes and free cash flow for Chevron well into the next decade, as they put it. This isn't just incremental growth, it really represents a potential step change in the company's long-term production and cash flow profile.
Okay, so Hess Guyana is the clear growth engine. What about those permanent impairment risks? The things that could really break the company long-term?
Right, any long-term investment comes with risks, and we need to be clear-eyed about them. I see 3 genuine long-term risks that could, theoretically, permanently impair Chevron's business model or its earning power. The first, and arguably the most significant long-term risk, is an accelerated energy transition. We touched on this, but imagine a scenario where the global shift away from fossil fuels happens much faster than current mainstream projections anticipate.
What could cause that acceleration?
It could be driven by a truly disruptive technological breakthrough, maybe in solid-state batteries, making EVs vastly cheaper and longer range, or maybe in producing truly scalable, cost-effective green hydrogen. Or it could be driven by a dramatic, coordinated, and sudden shift in global government policy that goes far beyond current targets, perhaps spurred by worsening climate impacts. Such a scenario could lead to a structural, permanent decline in overall oil and gas demand much sooner than expected. This could potentially strand Chevron's vast long-life reserves, meaning the oil is still in the ground but uneconomic to produce and permanently impair their economic value.
Okay, accelerated transition is risk number 1. What's next?
Second, we have to consider geopolitical instability and asset expropriation. Chevron's global footprint, while providing diversification benefits, inherently exposes it to significant geopolitical risk. A large portion of its current production and future growth comes from regions that are, shall we say, politically sensitive. Think Kazakhstan, which relies on a pipeline through Russia. Think the Eastern Mediterranean. Think parts of Africa or South America. A major regional conflict that disrupts critical infrastructure, like that Kazakh pipeline, for an extended period could be very damaging. Or worse, the outright nationalization or expropriation of a key foreign asset by a hostile or unstable government, basically. Having a major asset seized without fair compensation could permanently destroy a significant chunk of the company's earning power overnight.
The risk of operating globally in unstable regions. Makes sense. What's the third major risk?
And the third one, which is always present for major energy producers, is the risk of a major operational catastrophe. Think of something on the scale of the 2010 Deepwater Horizon oil spill involving BP. Such a large-scale environmental disaster represents a severe, potentially existential risk. An event like that could result in truly catastrophic financial liabilities running into the tens of billions of dollars for cleanup, compensation, and fines. It could cause irreparable reputational damage that takes years, maybe decades to overcome, and perhaps most critically in the long run, it could lead to the permanent loss of the company's social license to operate.
Loss of social license, meaning
a loss of public trust and government goodwill so severe that it leads to draconian regulatory restrictions, making it incredibly difficult or even impossible to get permits for future growth projects, effectively crippling the company's long-term prospects even if it survives the initial financial hit. So this definitely raises an important question for any potential long-term investor. When you're considering holding for a decade or more, how do you weigh these identified potentially significant near-term growth catalysts, like Guyana, against these truly existential but perhaps lower probability long-term risks, like a super fast transition or a major disaster? That's the judgment call.
That's the essence of long-term investing right there, weighing those probabilities and impacts. Okay, this brings us to second-level thinking. To develop a truly differentiated view, something beyond the surface, it's essential to understand what the prevailing market consensus is and then identify precisely where our own analysis might diverge from that. So what's the general word on the street about Chevron among analysts and investors right now? What's the common narrative?
The current market narrative surrounding Chevron, if I had to summarize it, is probably best described as one of cautious optimism. The consensus view, which you can see reflected in the typical moderate buy rating from Wall Street analysts, is generally that Chevron is a well-managed, financially stable company. It's seen as a reliable dividend payer, maybe even a decent hedge against inflation because oil prices often rise with inflation. However, this generally positive view is consistently tempered by those two big concerns we've discussed. The inherent volatility of commodity prices that always creates uncertainty around near-term earnings, and those long-term structural headwinds posed by the energy transition. So, the market largely views Chevron as a mature, perhaps somewhat stodgy value stock, a good place maybe for income investors, but not necessarily a dynamic long-term growth compounder.
Cautious optimism, tempered by volatility and transition risks, mature value stock. How does our analysis, the perspective we've developed here, differ from that consensus view? Where's the contrarian angle?
Our analysis differs from that market consensus primarily by placing a much greater emphasis, a heavier weight, on two key elements we've explored: the widening nature of Chevron's cost advantage moat and the exceptional quality of its recent capital allocation, particularly the Hess acquisition. The market, in our view, seems to be underestimating how the powerful combination of these two factors, getting structurally lower costs and making smart, timely investments, has created a business that is not only significantly more resilient than many of its peers, but also possesses, we believe, superior long-term growth prospects than the market currently gives it credit for. The market appears to be pricing Chevron largely as just another typical commodity producer, a business whose fate is almost entirely subject to the whims of the global oil market. We, on the other hand, see it more as a best-in-class operator whose entrenched low-cost position and highly disciplined management allow it to generate significant value through the entire commodity cycle, not just at the peaks.
And how does the Hess acquisition fit into that divergence?
The Hess acquisition is a key point of divergence. The market largely seems to view it primarily as just a way for Chevron to add more barrels of production to its portfolio, maybe extending its production plateau for a few more years. Standard industry stuff. We, however, see it quite differently. We view it as a potential masterstroke of capital allocation. It secures a multi-decade, high-return, low-cost growth engine in Guyana, a truly unique asset, and does so using stock preserving their balance sheet strength. It's strategically brilliant, in our opinion. So, putting it together. The market seems to be pricing Chevron as a mature, relatively low-growth, albeit reliable, dividend payer. Our analysis suggests that, partly thanks to Hess, it has actually just acquired a growth profile that would be the envy of many smaller, more highly valued independent exploration and production companies. The market, we believe, is significantly underestimating both the duration and the magnitude of the free cash flow that is likely to be generated from Chevron's advantaged positions in both Guyana and the Permian Basin over the next decade or more. And it's that underestimated cash flow that we think will fuel decades of potentially superior shareholder returns through dividends and buybacks, exceeding the market's current, more muted expectations.
That's a very clear articulation of the potential mispricing or underappreciation by the market.
Okay, you've laid out a very strong and detailed case. Let's try and bring it all together now into a concise one-pager summary for our listeners. What are the absolute strongest arguments for owning Chevron for the long term, the bull case? And then what's the most compelling counter-thesis, the bear case?
Okay, let's synthesize it. The bull case, the core reasons to own Chevron, really rests on four strong pillars based on our analysis. First, durable, low-cost producer. Chevron possesses a portfolio of genuinely world-class, low-cost oil and gas assets. Key examples are the Permian Basin, now Guyana via Hess, and the Tengiz field in Kazakhstan. These form a powerful and, we believe, widening cost advantage moat. This ensures profitability and a robust cash generation, even if commodity prices are lower, giving them resilience.
Pillar 1, low-cost durable assets.
Second, exceptional capital stewardship. We've seen a proven, multi-decade track record of highly disciplined capital allocation from management. The evidence is clear. A fortress-like balance sheet, that incredible 36 consecutive years of dividend increases, and a history of strategically sound, value-accretive M&A like Hess. They act like owners.
Pillar 2, great management, owner-focused.
Third, embedded, underappreciated growth. That recent Hess Corporation acquisition is key. It provides a clear, multi-decade runway for high-margin production and free cash flow growth coming from the Guyana Stabrook block. This is a world-class asset that we argue the market has not fully priced into what it still perceives as just a mature value stock. The growth potential is being underestimated.
Pillar 3. Hidden or undervalued growth from Hess Guyana.
And fourth, attractive valuation for quality. Considering the business quality, the moat, the management, and the growth outlook, Chevron currently trades at what appears to be a reasonable valuation. It offers a secure and growing dividend yield of around 4.5% right now. This combination provides, we think, a compelling total return proposition for a business of this caliber and resilience. It's a fair price for a great company.
Okay, that's the bull case. Now the flip side. What's the most compelling bear case, the counter thesis? Why might owning Chevron turn out badly?
Right. We have to consider the other side seriously. The bear case also has, I'd say, 4 critical arguments. First and foremost is the existential threat of energy transition. If there's a rapid, perhaps policy-driven or technology-enabled acceleration away from fossil fuels globally, much faster than expected, it could lead to a permanent structural decline in demand. This could result in stranded assets for Chevron and the potential destruction of the company's terminal value. This is the biggest long-term cloud.
Bear point 1. Transition risk is real and could accelerate.
Second, inherent cyclicality. Let's not forget, Chevron is still fundamentally a commodity producer. Its earnings, its cash flows, and ultimately its stock price will always be subject to the unpredictable and often severe swings of global oil and gas prices. You have to be willing to ride out that volatility.
Bear point 2. Commodity cycles are unavoidable.
Third is geopolitical risk. As we discussed, a significant portion of Chevron's key assets, and especially its future growth projects, like Tengiz and potentially others, are located in politically unstable or sensitive regions around the world. This exposes the company to the ongoing risk of operational disruptions, unfavorable fiscal changes imposed by governments, or even, in the extreme, asset expropriation.
Bear point 3. Global operations mean geopolitical exposure.
And fourth, execution and integration risk. The bull case relies heavily on the successful execution of massive, complex mega projects, like the final phases of Tengiz FGP and the ongoing multi-billion-dollar developments in Guyana. Getting these done on budget and on schedule is critical. Additionally, the seamless integration of the very large Hess acquisition into Chevron's existing operations is vital. These things are not guaranteed. They carry significant operational challenges and risks. A major delay or cost overrun could hurt returns.
Bear point 4. Execution risk on huge projects and the Hess integration. Makes sense. Okay, this naturally leads to the final challenge. To rigorously test our own bull case, we absolutely must aggressively challenge its core assumptions. We need to red team it. So what's the single most compelling argument for why an investment made in Chevron today could ultimately become a major long-term mistake? How could the bull case be completely inverted?
The most compelling argument, the scenario where buying Chevron today turns into a major long-term mistake, hinges on this. We are fundamentally overestimating the inertia of the global energy system A&D, at the same time, critically underestimating the potential exponential pace of both technological disruption and the political will to force change regarding climate.
So we're too complacent about the speed of change.
Potentially, yes. The bull case, as we've articulated it, rests heavily on those forecasts projecting pretty durable oil demand for the next 15, maybe 20 years. But the red team question is, what if those forecasts are just fundamentally wrong? What if they suffer from linear thinking in an exponential world? What if a true breakthrough, say, in solid-state battery technology that dramatically lowers EV costs and doubles range, or in producing truly scalable, cheap green hydrogen doesn't happen in 15, 20 years, but happens in the next 5 to 7?
5 to 7 years is a radically different timeline.
Radically different. Such a development wouldn't just flatten the demand curve for oil. It could cause it to, quite literally, fall off a cliff much faster than anyone anticipates. In that scenario, the projected cash flow runway from Chevron's supposedly long-life assets, even the fantastic ones in Guyana, gets dramatically shortened. Their terminal value, what they're worth beyond the next few years, collapses. They become worth a fraction of what the bull case projects today.
Technology could pull the rug out much faster. What about the political angle?
And what if the mounting social and political pressure against the entire fossil fuel industry reaches a critical tipping point much sooner than expected? Imagine this manifests not just as stricter regulations, but as truly punitive measures. Maybe widespread windfall profit taxes that essentially confiscate any remaining upside when prices spike. Maybe a complete coordinated ban on all new exploration and development permits in key jurisdictions like the US, Canada, Europe, effectively choking off any possibility of future growth or even reserve replacement. Or perhaps a wave of successful climate-related litigation that assigns massive, legally mandated financial liabilities onto companies like Chevron for their historical emissions, crippling their balance sheets regardless of current operations.
So a perfect storm of faster tech disruption and much harsher political legal action.
Exactly. In that scenario, Chevron's vaunted low-cost moat becomes almost irrelevant. Think about it. Being the low-cost producer of a product whose demand is collapsing while facing soaring environmental liabilities and punitive taxes, that is still, unequivocally, a bad business to be in. The company would no longer be viewed by the market as a durable cash producer, but as a melting ice cube in a rapidly warming world. Those assets acquired from Hess, which look like growth engines today, could transform into huge liabilities, representing capital spent just before the cliff edge. The stock, bought today at what looks like a fair price based on current projections, would be brutally exposed as a classic value trap. We, as investors, would be left holding a declining asset with shrinking cash flows, mounting legal and environmental costs, and potentially evaporating dividends. It would be the very antithesis of the wonderful company we set out to find.
Here's where it gets really interesting. That red team challenge truly forces us to confront those deepest uncertainties. The potential for genuine paradigm shifts in how we power our world, shifts that could invalidate decades of historical precedent. It's not just about incremental change anymore. So we've taken an incredibly extensive deep dive into Chevron Corporation today. We've covered its integrated business model, its formidable and arguably widening moat, the disciplined stewardship of this management team, its current valuation, and importantly, both the compelling bull case and that sobering bear case, including the red team challenge. So what does all of this mean for you, the learner, as you grapple with the complexities of long-term investing, especially in these foundational industries that are clearly facing profound evolutionary, maybe even revolutionary pressures?
I think it means that this kind of multifaceted analysis is absolutely essential. We simply cannot rely on simplistic headlines or prevailing narratives, whether bullish or bearish. We have to dig deep into the underlying business fundamentals, the assets, the costs, the operations. We must rigorously assess management quality and, critically, their capital allocation decisions. And perhaps most importantly, we have to constantly challenge our own assumptions and biases. Considering multiple perspectives, especially those that actively invert our own preferred thesis, like that red team exercise, is what truly enriches our understanding. It helps us appreciate the range of potential outcomes and hopefully make more robust, less fragile investment decisions. There's always more to learn, always another angle to consider.
Absolutely. It's about building that robust understanding from all sides. And as you, the listener, mull over everything we've unpacked today, perhaps consider this final provocative thought. How do you personally weigh the immense undeniable inertia of the current global energy system, that vast installed base of hydrocarbon-dependent infrastructure, and the slow turnover of assets against the clearly accelerating pace of technological disruption in areas like batteries and renewables, and the shifting political and social will to combat climate change? Which of these powerful opposing forces do you ultimately believe will dictate the long-term trajectory, the fate of a company like Chevron over the next 1, 2, or even 3 decades? Something to think about. Thank you for joining us on this deep dive. Keep that curiosity alive, keep questioning, and we'll catch you on the next one.